The opinions expressed on Two-Way Traffic are those of Darren Coleman and are for general information purposes only. It does not constitute any legally binding engagement between the podcasters and anyone else. Always check with your advisors to obtain your own tax or investment advice. Welcome to Two-Way Traffic with Darren Coleman. In this series, Darren aims to guide you through the complexities, complications, implications, and most importantly, the advantages of having money and family on both sides of the border. In this episode, Canadian and American CPA Carol Sadler joins Darren to help you avoid headaches and reduce taxes when buying U.S. real estate. Enjoy.
Hi, everyone. Welcome to another episode of Two-Way Traffic, the podcast, where we discuss all things cross-border. So you have money and family on both sides of the border. This is the place you want to come. Today, I'm joined by Carol Sadler, who's a partner and cross-border tax accountant with Achen Henderson in Calgary, Alberta. So, Carol, welcome to the podcast today.
Oh, thank you for having me on. I'm glad to be here.
Now, you and I had a visit about a month or two ago. I was out in Calgary, and we were just talking about the weather. We're getting I'm in Oakville, Ontario, near Toronto. We're getting a proper Canadian winter. We are. You guys kind of get those anyway in Calgary, so we're both shivering a little bit.
Yeah.
So this is a perfect time to talk about real estate in the United States. This is the time of year where many Canadians, they're snowbirds. They go down to somewhere a little bit warmer to escape these climates. In Ontario, many of them go to Florida. I imagine in Calgary, that one of the popular destinations would be Arizona or Texas. Is that a reasonable guess?
Yeah, a lot to Palm Springs. Palm Springs is both Palm Springs and Scottsdale. A little bit, a few places in Nevada, Henderson outside of Vegas are all under a 3 hour. What am I saying? Flight. So those are pretty popular. I think you're about the same. What's it? 3?
Oh, it's yes.
hours.
This is it. I think people like that 3 hour kind of commute. As it were. And some of our clients on the West Coast, they'll make a bit of a longer trip, but they'll go to Hawaii and things. So, so very popular for Canadians at this time of year to escape our lousy winter and go to somewhere in the United States. So buying real estate, holding real estate, maybe selling real estate, very common situation that you and I both encounter. But it's not without its complexities, is it? It's not as simple as buying a house down the street or around the corner. So why don't we kind of tackle each one of these one at a time? And I think we'll go in reverse order because in terms of what people are probably doing right now, because our dollar is very weak compared to the American dollar. So we're probably not seeing a lot of buying. But if somebody did want to go buy a property in the United States right now, is it just as simple as them just going down and buying it? Or are there some tax things they need to have at the front of their mind before they go to make a purchase? What should they be thinking about?
You always want to, in tax particularly, you always want to be thinking with the end in mind, to quote Stephen Covey, and exit. So what's great, easy to buy it now. What's going to happen when I sell it? So I've got, when I dream fondly of my condo in Palm Desert, that's great. I'll use it. What happens when I don't want to use it? Want to sell it? There's also estate issues we can talk about a little later on. So the idea is to think about who's going to own that property and how you're going to own it when you buy it, because sometimes it's a little difficult to change the type of ownership. And if you're thinking of people who are truly snowbirding and generally not using that property as a rental income earning vehicle, you pretty much have sole individual ownership, joint tenancy, tenants in common, joint titles. Two spouses have their name both on the title. You could hold, if estate tax, we'll talk about that later, for larger properties is going to be an issue, you could hold that property in a trust. Also works if it's something where the family's all gone in it. So, here I am with, say it's me and a spouse and 4 adult kids, and everyone goes, yeah, we want that place. We know we're all going to use it for years and years. Maybe we'll put it in a trust. It is, without dragging a bunch of legal and lawyers into it, it is somewhat difficult with U.S. property and being across the border to put that property in trust later on. Not impossible, not easy. So, I want to save your money up front. If you're thinking about that, perhaps look at a trust to begin with. And the way I'll approach it, people say, and any idea what you're thinking of now? Because a trust in the U.S. is a different beast from in Canada. and to make it work across the borders is expensive. So you've got to have the possible need or a good thought that you're going to have that need to keep it going through generations, and or a fairly large dollar value property, and or an estate that's such that you want to protect it. Otherwise, probably individual ownership. If you're worried about taxes, insurance is actually not a bad way to cover potential.
Okay, so let's unpack that, because there's a lot in that.
I threw a lot at you.
You're all about the value. So from our perspective, when we have clients that are asking about going down and they want to buy a property, one of the first things I ask them about, and this is, I think, from where you started, I think the first question is, how are you going to buy the property? And meaning, is it really just for your personal enjoyment, or are you planning to have any business component? Like, are you going to rent it out, put it on Airbnb? What is there an income generating side of that? So why don't we just start with those two streams? So someone wants to buy it personally, which is, I think, how most commonly, and it's just me, my family. I'm not going to rent it out, not going to drive any income. The first thing we talk about that you mentioned there is, how do they want to own it? They want to own it in their name, joint names with somebody else. So let's say it's a couple, they want to buy it in both of their names. Is that, and then you talk about joint survivorship and tenancy. What's the difference? Because they can pick. So why don't you just explain, if you buy it,
they can pick. They can pick.
So what's the difference?
It almost goes. It's good to talk about, because in Canada it almost goes without saying that you acquire property jointly, which means if you and I are joint tenants on that property, my half when I'm deceased goes to you. Doesn't matter what else I might want to do with it, you're going to get it. Tenants, right?
So you and I buy it together. I go surfing. I get eaten by a shark. It's all yours.
I have full ownership.
Yeah. So not that you told the shark to bite me, but because we're not going to talk to the cops. Right. So that's the most common expectation that people have is if, so for example, husband and wife own it together, husband, wife, whatever the pronouns are, they own it together. One passes away, it'll automatically flow to the other person. People think that's automatic, but is that always the case?
Tenants in common. Now the difference is tenants in common are not, and that's where you might have tenants in common in situations with the number of people owning the property. Say there's 2 or 3 couples want to own a property together. I've seen that.
Well, we can see families doing it, right? Like
families doing it. Yeah,
like two brothers decide they want to go and buy a property together. And you'll own it you'll have it for those weeks. We'll share the property. This is very common. We see with vacation properties or cottages. Families will buy a property together. And I think this is where the tenants in common is a more appropriate structure. So how is that different than the survivorship one?
You own and can pass on your share. So if there's, say, three brothers owning the property, owning the condo down in Florida, and one's deceased, that person can transfer that share to whomever. It's going to go to my spouse. It's going to go to my kids. Oh, maybe I agreed it's going to go back to you guys, but it's not automatic. Right.
So it kind of stays with their family as opposed to automatically getting transferred to the other people, right?
It stays in the estate and is disposed of as that person wants.
Right.
And the possibilities are infinite from there. I'm not sure how far we want to go down that.
No, it's okay. We don't go too far down the rabbit hole. But I think this is an important distinction when people are going down. If they're buying it for their own use, is how do they own it? If they own it as a couple, then survivorship is probably the one that they want to make sure that they have. And this applies to people that already own a property. They may want to double check what their paperwork says, right? But if they own it as a family, the tenants in common, so because you wouldn't want a situation where 2 brothers have bought a property together, they both have families, and they're going to share it, and then one brother passes away, and their family doesn't get anything.
Exactly.
Because we unfortunately see that sometimes, where people didn't realize that distinction of survivorship versus tenants in common is critically important. So you've got to get the right one to match your scenario, right?
You do. I mean, there are things that can be done through a will or through an executor, but it's not easy. Not easy, costs time and money, and it's at a tough time already. So definitely something to look into. And I like what you've said. It makes a lot of sense about so when you just keep tips in the back of your mind, if it's a one family situation, spouses, maybe kids, spouses particularly, joint makes a lot of sense. In some properties, this is where you need advice in the state you're going to go to. Arizona, for example, because we sit a lot here, is what's called a community property state, which
Mm,
means if you are spouses, it is joint, we don't care. That's how it starts.
okay.
There are ways to get out of that because you might be in a situation where this is a second marriage and you buy um, the condo, but basically, I want it, and the second marriage, I don't really want to go to my spouse. My spouse is cool with that. You've got to do a bit of due diligence where you are to make sure that that's right for you. But generally, that's the way to look at it: is spouses, joint, other groups of people probably make it tenants and make the title tenants in common.
Yeah, or even when parents are, because we do see parents buying properties with adult children, and they think, well, I'll put a joint with my child, so if something happens to me, they automatically get it. But it really comes down to making sure whatever they think they want to have happen in their planning scenario, the paperwork and the process actually make sure that happens, right?
Exactly.
So okay, so let's stop on that one right there, that complexity.
Sure.
Let's go and say, well, what if they say, well, I want to buy the property, and you know what, I'm going to put it on an Airbnb. I can only use it for certain times of the year. I'm not going to use it all the time. I want to put it on Airbnb, and I want to drive some rental income. Is that anything that comes up as a potential complexity when they do that?
Not really. Individual ownership is still not a bad idea. One thing to be careful of is that the in rental or business situations, the U.S. uses, and often people will recommend, advisors will recommend LLCs, limited liability corps.
Yeah, so that's a
Those
good
don't
point.
work.
So they say, look, you're going to drive rental income out of it.
Yeah.
It's very common in the United States that American will use a limited liability corporation to get some tax benefits, they think, for doing this. And we've seen this. Someone says, look, my neighbor who I see every season, they're from Michigan. They did this, so I should do this. So, okay,
Yeah.
so they want to get the corporate. So why is that a problem? Why can't they do what the Americans do?
It's a problem because of Canadian tax law. I'll be honest. Not that I want to blame CRA, but I am, or
Okay.
Department of Finance. Take your pick. Probably Department of Finance. They make the law. An LLC is generally a flow. It's what's called a flow through corporation. So it's used often in the U.S. for creditor proofing and protection. I'm worried that someone's going to slip on my sidewalk or slip on the pool in front of my
Sure.
condo, and they're going to break
Right.
their leg and sue
And
me.
Americans love to sue each other, right? So this is something I think
love to sue
we
each other,
assume,
yeah.
right? They love to go to court. We got a whole TV show called People's Court about this. They got Judge Judy. It's a whole thing.
You got it. So so the there may be defense. You can have insurance, but it's a worry.
Yeah.
So the corporation does protect against that because, as with corporations in Canada, your liability is limited to what's in the corporation. I think that's the picture I want to draw for you.
Right.
So your personal assets can't be attacked. They're going to, and that may also deter, actions like, well, this guy has his condo with the mortgage, the equity is this, that's all I can get, it's on the corp, maybe I'm not going to take a run around him. So it's really creditor protection, but the LLC, the limited liability corp, as we talk about, we have that in the U.S. and we talk about corps in Canada. One of the other tax benefits of that is the income is reported on the owner's return.
Okay.
So in Canada, a corporation is a separate entity. We created it through these papers we filed. It files its own tax returns. It bears the tax. It does its thing. A limited liability corp in the U.S. is a flow through, and that comes from U.S. past tax history, where the U.S. corporate used to be really high. It was like 35% plus state tax. It was almost the second highest rate you could pay. So nobody wanted. So basically, it was a marriage of, hey, let's marry the best of lower personal tax rates and higher and protection and creditor proofing. Problem is, Canada now says, oh, corporations are created by a statute. They are separate legal entities. That's how we're going to report it. So you have the issue of, in the U.S., let's say you've got a fairly successful Airbnb going, you've got income, you pay tax in the U.S. You're a resident of, but it's through an LLC, you're a resident of Canada. The corp does not exist in Canada. You exist in Canada. you're recording income in a different way only when you take money out of the company, and you can't use those foreign tax credits. You're getting double tax. That's just, without my getting into the details, I would say the problem is double tax, ugly, don't want it.
Yeah. So right. So this
Yeah.
this is a really important point, is that if you're going to earn rental income, you're going to rent the property out on Airbnb or to friends. First of all, it's taxable, right?
Yeah.
So that's the first thing. And you're going to have to now file a U.S. tax return, not just
You
the
are.
Canadian one. So that's more complexity, because it's not just I'll rent it out, I'll make $10,000 or $20,000 a year, and I just tell Canada. No, you got to file a tax return federally and in the state that you have the property. So that's complicated. And you're right. If people then adopt what is a very common strategy for American residential real estate owners, is to use this LLC, the tax rate that you're going to wind up having is almost double what it would normally be without that structure for Canadians. So that's a huge problem, right? So they could say 60 and 70% tax rates on the income.
Oh, absolutely, absolutely. It can be managed. There's certain ways to manage it. So first, again, structure is really important. That's something we've been seeing a lot when you mentioned Airbnb. I'm seeing a little bit more in the U.S. because of some of the rules in Canada where Airbnbs are restricted in certain areas. So
Yes.
the U.S. is a place to go. I also see it for people who know that they're not going to use, they want the place, but they know they're not going to use it a lot. I've decided I really want my place in Palm Desert, but I'm a tax accountant. I'm busy from February to April, so maybe I'll use it for a few months. Otherwise, in the fall, maybe I'll use it for January. Maybe I'll rent it out for a few months there. Get it, might as well get a bit of help with the cost. I'd say you want to look at ownership there, kind of based again, kind of the way we talked about it for personal use properties. Who's going to do what with the corp? If it's me or my family and we're going to rent it out a little bit, it's also a bit more complex if I'm now, not impossible, but a little more complex. Going, okay, can't take those expenses for those months because I was personal use. Can't take those expenses because now we're renting it. Not impossible, just a bit more work.
That's right, because if they're going to rent it out and they've got their property tax utilities, they can't just deduct all of the full year's worth of expenses against 1 month's worth of rental income. They have to now do their proper record keeping. So this is another complexity that people need to be mindful of. If you're going to use it for any source of income, you've now got all these other things you have to pay attention to. You got to do your bookkeeping right, track your expenses, track your income. You've got to make sure that you report it correctly to the various tax authorities. You got to be mindful of your structure. Do I own it myself? Do I own it jointly? Do I own it not in an LLC for Canadians? There's this cross-border trust that you mentioned. What could you maybe paint a picture of what that solution or that structure could look like for people?
I tend to see that more in situations where the family knows they want, or at least believes at the time they want to maintain that property for some time, possibly through the generations. Generally, when it's a more expensive property and or a higher net worth for the owners or the parents. So the idea, like the corp, is a trust is created by filing the papers. It's a separate legal entity. And it basically says, hey, we have this item, this piece of real estate, and it's going to be held so as where corporate owners have direct ownership of that corp, or when we're on title, we have direct title. A trust has trustees who manage the properties for the beneficiaries. So we used to joke a ways back about calling that was the biker gang clause in the trust. If daughter Susan shows up with some people you're not very happy with in tow, it's like, sorry, you're only a beneficiary. Trustees decide who gets what income, who gets to use what, who gets to do these things. So it provides continuity, and it provides trustees. So it could be mom and pop are trustees for their ownership and all of the kids and spouses, for example.
Right. So it allows somebody to have a little more control over what happens with that property, and which is really important when you get to extended families, because you're right. Someone may bring their biker gang friends over, and it's like, oh, we don't really want them to be owners or whatever. So you're right. It does provide a little more visibility, I guess, to what the outcomes could be. than just people owning it, right? So that's another very interesting complexity that people can have. Now, let's talk about that's how they purchased it. So they figured out, they got the right structure. They're holding it. They're maybe renting it, not renting it. Let's move to somebody selling a property. So they've bought the property a few years ago. They said, you know what, for whatever reason, I think the time of me owning that property is kind of come to an end. Time to let it go.
Yeah.
They want to sell it. What are some of the things they need to think about? Is it just, I bought it for $100,000, now it's for $300,000? I just declare the profit? Or do I have to be thinking about a few other things, like what currency it's in or what tax rate I pay? How does that work?
Yeah, currency tax rate, withholding tax is the big thing.
So what are withholding taxes? Now that you mentioned,
we'll go. Individual ownership is going to attract withholding tax because you're not a U.S. person. You're not a citizen, not a permanent resident, green card holder. Don't reside in the U.S. long enough to be a resident there. Yeah, in that case. And I will say in a lot of these rules I'm talking about for individuals, the same thing would happen for someone from Arizona owning a place in Edmonton because they want to get away during the summer. We have reciprocal rules. So the U.S., I will say, the U.S. is not picking on Canadians or foreign nationals. The idea is that residents of a country should pay tax on their worldwide income to that country because we're using all the resources, and certain transactions dealing with things in that country, like land, of which every country has its land, and that's all they got, should be taxed as well. So the U.S. is saying, hey, you own U.S. real property. We essentially get first dibs, if you will, on taxing that property. And the way they ensure that, because it is somewhat difficult to find someone across the border, is that there's a withholding tax. So we use lawyers here generally for property transactions, almost always title agents who are essentially paralegals in the U.S. And they're required on behalf of their buyers to ask, hey, are you I'm buying this from you. Are you a non-resident? Because under U.S. tax law, if the IRS later on found out that I'm a non-resident and I didn't file or pay any taxes, they can go to the buyer and say, did you ask? Can you show us the proof? Did you get someone to sign that they're a resident or non-resident? And otherwise they can chase the buyer for the tax. So the question is always asked. I say, oh yeah, I'm a non-resident. Say, great, we're withholding 15% of the purchase price off the top and remitting it to the IRS. You'll file a tax return for the actual gain, pay your actual tax, and get your refund.
So there might be so first of all, you're not going to get as much as you thought because you've got to have that withholding tax calculation done, that you've got to remit. And then you may or may not get some of that back, but it's months and months or a year or so away, right?
It could be.
You've got to file to get it back.
Yeah, you got to file to get it back. Timing is difficult. There is an application process that the IRS has where you can send them the calculation to say, in our case, hey, I bought it for 100, it's worth 200. I can do this mental math in my head. Here's my 100 gain. The tax is only going to be $10,000, but you're withholding 30. Can you please reduce the withholding? The difficulties with that, I found the IRS is really slow these days. The IRS does make revenue CRA look pretty good. They're underfunded, the poor guys. Yeah. It is amazing.
Whereas I think we have more auditors than people in our military in Canada. We're very good about that. So, yeah.
Probably. So, and other way, of course, around the States by a big margin. Point is, it takes them at least a few months to get you back that certificate or statement says, yes, we agree. And the title folks and the buyer have to be on board because I said it's technically their responsibility to make sure that the withholding is done. So practically that means my $30,000 goes into escrow for 3 or 4 months till the IRS gets back to us and says, yeah, 10,000 is good. And then they give you my 20. Still have to file a tax return regardless. So I tend to advise people it's a matter of time. If it's getting into an August or September sale, let's just file. Let them take the money. Let's just file.
Okay. So that's important that people need to know that there is going to be withholding tax, and they're going to have to see part of their money tied up while all
Or,
this
yeah,
gets attended to.
yeah.
Now let's talk about the calculation. So, if someone bought that property a bunch of years ago for $100,000, they sold it for 300,000 or 400,000 today. The US, that's where we're going to get to withholding tax and everything else
Yeah.
on the US side. How does Canada look at that transaction? Because that's got to be reported on the Canadian tax return, right?
You bet. I mentioned that you pay tax on your worldwide income to the place you're resident. For us, that's Canada. So we've got to report that that gain in Canada. So I basically said the IRS, the way I put it is, they get first dibs. They get the tax first. We've got to figure that out first. Then in Canada, we've got to report that that gain, but under Canadian rules, which means converting into Canadian dollars. So you convert your 100,000 cost at the conversion rate when you bought it. You report your $300,000 or $400,000 at our, where are we at now? $1.36, $1.39. I haven't looked lately. You get the point. Conversion rate there. So there can be a currency gain, which, much as it doesn't feel good, in a way makes sense, because that's the purchasing power you got from those dollars today.
So it's actually possible, because you're right. So if somebody bought the property, you got to pay attention to what was the exchange rate when you purchased the property. So you got to remember, what day did I buy it? And you can look it up, historically, to say, what was the exchange rate when I bought it? But you got to know the date, and you got to know that you've got to do this. And then when you go to sell it, and it's possible because of how much our dollar moves around versus the US dollar. Like right now, if you bought that property years ago, you've got an additional profit in the currency that is taxable. But you could actually have the opposite. If you'd bought when our dollar was weak and then sold when our dollar was strong, you may make a gain on the property. You may actually gain on the property. You could lose on the currency, right?
Yeah,
so that's
quite
a weird
true.
set of funhouse mirrors that you have to deal with, isn't it? Like, you've got to look at, what did you make or lose on the property? But then you also have to say, did I make or lose in the currency? Because we've had people that have lost on the transaction but made money in the currency. They're like, how'd this work? I actually got less money in the US side, but when you bring it to Canada, now I got to pay tax when I actually lost money in the property. That's weird.
It is. Those are the rules. I wish I had something more. I mean,
but it's really problematic if somebody's going to reinvest it to another property.
Yes.
Yeah. Because it's not like they're pocketing it and saying, I'm going to buy a property in Canada and that higher dollar is valuable to me. It's like, wait a minute, I'm not actually changing my US dollars. I'm just moving from one property to another. But Canada says, no, that's a taxable event. So people need to be really mindful of this, don't they?
It is, and it's a question I get asked a lot. Can I leave them? What happens if I leave I may not want to reinvest, but what happens if I want to leave the dollars in the US? And Canada's view is, it doesn't matter where the dollars are. For tax purposes, you've economically made a gain. It's got to be measured in this way in Canadian dollars. And what you do with that money after that is essentially your problem. So,
do you find people are surprised about that? That they think, well, I'm leaving. I sold the property in the United States. I'm going to buy another one in the United States. I'm leaving it on US dollars. I didn't convert the money. So why do I have to pay tax on that? Because it's a theoretical thing. But they do.
But you do, exactly. You do. So that's something we'll tend to look at is doing an estimate and planning for that tax. It's because we are going to get a foreign tax credit in Canada. You're not going to be double taxed, but there can definitely be an uptick in the tax due in Canada because of the exchange rate.
Right.
Depending on your level of income, otherwise too. In a lot of cases, the tax rate is going to be higher in Canada than it is in the U.S. because the U.S. taxes that gain at a few $1,000s at 0, some at 15, some at 20%. So never go above 20%, plus state tax. But in the states we're talking, California's high. Arizona's not, Texas is not, Nevada has nothing, Florida has nothing. California's about the only state where the rates are starting to approach Canadian.
They look close to Canada,
rates. They are, they've got a very high state tax rate. A lot of state tax rates are 3-4%. California's 8 or 9%. So if you have a very large gain and California state tax, it could be at 28, 23 to 28, say, percent, which is getting into Canadian territory because we're at 40 to 48% once you get much over 200 and some odd thousand, 250,000 worth of income. So, I mean, and those amounts are taken up by your income in Canada. Otherwise, you're
Right.
employed, or you have pension, or you have investments, or some combination. Now you tack the gain on top, if you will. So essentially, you're taxing most of your gain at
The
now
top rate.
half or 2/3. And wow, we could start
So we'll
getting
get into that,
political
this
here.
complexity in a second. Yeah.
Stay tuned. But yeah, so you're going to be at something like 20 to 30 some percent rate in Canada, very, very easily, depending on province and what happens with gains, versus maybe 15 or 20 in the US.
A
So
much higher
you have,
tax bill here.
you have a higher, I find a lot of these, I'm just the bearer of bad news all the way across. Hi, yes, you have to pay tax in Canada. Hey, you got to figure it this higher exchange rate. Yes, you got, no, it doesn't matter if you didn't take the money back into Canada. This is your gain. Oh, and here's your rate because your other income is this. So here's your, I mean, the prep for people, and I will warn them, is we've got a process in the US to follow. We've got to file a tax return there. We need to do that and get our foreign tax credit. And then you're going to pay. You're probably going to pay tax in Canada, and Canada's basically saying you had a gain, you made some money. In a way, they don't differentiate between you went to work and did some things and earned a salary. Oh,
Yeah.
you held this place, you earned it. One of the things I was going to mention is you generally won't therefore be tracking costs. This is purely a residential place. It's mine and my family's. We go down there for a few months here and there. But to the extent you do anything that improves the property, any betterments, that's part of the cost of the property.
Sure. Yeah. You put in a new dock for the boat. You put a new roof on. You put a new driveway in. You do need to pay it. Your home in Canada, not a big deal because the property, your principal residence, is a taxable in Canada, so you don't think about it. But you're right. If somebody has that second property or third or whatever in the U.S., if they make substantial, now not just a can of paint, right?
No.
Is there a threshold they need to kind of keep in mind where I should keep track of this, but this one isn't a big deal?
It's more of that definition of betterment or improvement. Am I doing something that is better than it was before, or I added to it? So you're right. I almost look at it and say, don't follow the general repairs. I fixed this doorknob, put a new coat of paint on, replace some of the carpet because it was getting weary. But otherwise, if you think you added something, I'd rather tell people to track it, then we can take a look. And I'd rather say, those might be a bit dicey, but let's take the rest of your list.
Yeah, like a new faucet. Those are in the maintenance category, I guess.
Yeah.
I guess the right advice might be like, what would a reasonable person think is maintenance? What would a reasonable person think is an enhancement, right? Because if you put another floor on the house, that's an enhancement, right? Yeah, but a new front door probably isn't.
Probably not, because I tend to tell people, like, did you have it before and do you need it? In that case, it's hard. Air conditioning, and probably the same thing in Florida, Arizona, California. There's one we encounter a lot. And I'll generally take that on the basis that they always seem to be improving. So, I mean, you need it. You can't live without it. But it's a better air conditioning than you had before. Let's try it.
Okay.
Let's try it.
Yeah. So but I thought the obvious ones would be if you made a substantial structural improvement, you added a floor, you put in a swimming pool, a new dock. Those are pretty clear. But it's important that I think people keep track of it and they have a discussion with somebody to say, actually, this ball lands on this side of the line versus on this side of the line. Because it can be a judgment call, right?
It can. It's something we'll always do. I'll give some direction. Say, come back with your laundry list, your shopping list of the things you did, and we'll figure out what we can use. Because in both countries, we're therefore reducing our tax, and it's truly something you added to the cost of that property. It's not affecting your taxes in any other way. So,
no, that's great advice. Now, we just touched on this a minute ago about the rate of tax you will pay on your gain when you sell that property, because you're right, whatever the taxable amount is, it goes on your top tax rate in Canada. But it's the calculating of how much you have to report is a little tricky right now, right? Because if someone has a capital gain, but let's say they made $100,000 in profit on the sale, do they write $100,000 of, is all of that taxable? Or how do they arrive at the math of how much of that is actually taxable and how much might be tax-free?
We only, in Canada, we only include a part of the gain. A little bit of jealousy for the U.S. side, where what happens is you include the whole gain on your tax return. Then there's a separate tax rate schedule that says, hey, what's my other income? What's my gain? Here's the lower rate on gain. I think it's pretty elegant, but then I may be a bit biased. And of course, it's very easy in the non-resident side because only income, gain, use the low rates. Anyhow, back to Canada. Up till June 25th, the inclusion rate was 50%. It's been that way for years. I'd have to count back. It has changed in the past. That was many, many moons ago.
Right.
Now and this is where the vacation property has been seen as an issue, is for individuals, gains over 250,000. If the proposals stay law, and we'll get to that shortly, but if they were, gains over the first 250 are now, two-thirds of the gain is included. Sorry, that wasn't an elegant way of explaining it, but I think you get my meaning.
Yeah, so up until June, you only paid tax on half of the gain. So $100,000 in profits, you only have to report the $50,000. So $50,000 was tax-free. Yeah. But you're right, they did say that after June, they being the current finance minister, the proposal was if you made more than $250,000, you had to include two-thirds. Correct. Not just the half on the difference. So there was like a bit of a hockey stick curve to the amount of tax you pay, right?
Correct.
So that would lead to a higher amount of tax if you had a bigger gain. So if you sold it for $100,000 profit, not a problem. $300,000 profit, well, some of it's going to be at that higher, what's called an inclusion rate. But that didn't get through before our prime minister says he's going to resign. So we've got this whole political turmoil that may or may not see that happening. So my understanding, and you can tell me if I'm right, my understanding is the way that the Canada Revenue Agency generally approaches situations, they don't happen often, where the government has said they want to do something, but they haven't done it yet. The CRA says, well, we're going to act as if the new rules are going to happen. Because the next government, when there's an election, they will probably follow through, but maybe they don't. So it's a real question mark, I think I'm hearing that people are having of like, well, if the new rules don't come, should I follow the new rules if they're not likely to happen? But that's what tax administrators are going to do. Or should I just say, you know what, I'm going to play by the old rules, assuming that the new rules don't happen. Do you have any thought about how people should approach it this year when they've got that question mark? If they have a big capital gain to pay, like, should I follow the new rules even if they don't happen, or should I just stick with the old rules and cross my fingers?
It's kind of a, news is breaking on this subject daily, and honestly, I've been rethinking what my advice with Pierre Poilievre's announcement yesterday, saying if the Conservatives come into power, we will not, we will rescind, is what they said. So
that changed the betting odds a little bit.
That changed the betting odds a little bit, yeah. So if we're talking today, not 3 days ago. Got something a little, couple little different thoughts for you. I've gotten this a little bit different, but I've got it's actually someone who's deceased, and they're selling the farmland this lady owned, and we've got like a hundreds of thousands of dollars swing in tax.
Wow.
So yeah, it's we've got there are a lot of big numbers in Canada riding in the line, and there's a lot of annoyance for everybody, even if it's just. You and I have, been trading in our portfolios, and I've got some gains. I happen to have a really good year, and by the time I get to December, I'm at $260,000 worth of gains with so much pre and post. Yeah. Now what? It's really affecting everyone. The general approach of the Department of Finance, where I mentioned having a little bit of sympathy for tax bodies, small bit of sympathy, very small. For CRA in this case, in that truly they administer, they do not make the rules. They take direction from the Department of Finance, who makes the law. The proposals did get as far as the Notice of Ways and Means motion stage, which means there was something put into Parliament. We might have a bit of a different scenario if this had happened back before that. And that actually took from April to September. So a lot of us not best pleased with the Department of Finance going, cool, you put out a budget. You announced something for June. I get that. That makes sense. You want to make a change. You want people to get their affairs in order. But comes the day, and we really don't have legislation that says exactly how this is going to work, what happens with losses. Got to do what you got to do what you think. Finally, September, draft legislation hits, but nothing happens in Parliament with it, so it's still there on the order paper.
Yeah.
Parliament is prorogued, dies. Basically, that bill no longer exists. The general practice is to say that there is currently a government in power whom, on Parliament resuming, will probably intend to to reintroduce that bill. Therefore, Department of Finance tells CRA, yeah, you should administer this. We think it's going to become law because had we been able to pass, we probably would have had a majority that would have voted for that. Yeah, it's going to become law. Administer things as if it is.
Yeah, do what we told you, even if we didn't get it passed. Just keep driving forward. Yeah.
Exactly. Do exactly. That's it. And CRA has announced they'll be doing that. CPA Canada is working with them quite closely to get some clarity on that and reaching out to say, look, this is what this looks like for people. There are a lot of other ramifications. Interesting thing now is, so we now have Parliament prorogued, so we don't. I could have understood if we were just waiting for the bill to pass, knowing that Parliament was going to go along, and somewhere in February, March, April, or knows, it was passed, or you think it's going to. Now, Parliament prorogued, when it comes back, who knows? Yeah, if I knew those answers, I would be down in Vegas. I'd be placing bets. I would not be prepared.
This is quite the crapscape. But this is, I think that from our perspective, this is a year that people really need to have a dialogue with a tax professional to say what is the right decision for me, because this is going to be a judgment call that they make with their tax professional. That if they get it right, great, they may have done the right thing, but if they get it wrong, they're going to have to refile, more cost, more complexity. So they're going to really have to be mindful and thoughtful, I think, as they approach it this year, and have a good conversation and decide kind of for their comfort level, their complexity, which way should I do this? So this is a very complicated year. Now, I want to move in our time that we have left to another very critical thing that when people have a second property that they need to be aware of. And I find that people that go down and have a second property, they're very aware of this, but there is some confusion, which is, how long can I stay in the United States as a visitor without having to pay taxes? Is there a risk that if I stay over a certain length of time, that the U.S. may tax me as a resident, even though I'm not a citizen, I didn't do any, but they'll just assume, you know what, you stayed so long, now you pay taxes here. And I think many people have this idea that as long as I'm in the United States for less than 6 months, I'm fine. Is that a good rule of thumb, or that might get you in trouble?
That's a pretty good rule of thumb. Tax wise, that 183 days is the U.S.'s limit. More than 183 days, and they consider you resident in the year.
Yeah.
So you want to stay there under 183 days. Now, if you did stay for more than 183 days, couple of options. Now, if it was a medical issue, there's a couple other issues. You can file form that says basically, I couldn't leave because I tripped on the curb, I broke my leg, and I've been in hospital in Scottsdale for 3 weeks. So sorry.
So there's room to allow for situations like that. Okay.
Yeah. There also is a provision under what's called the Canada-U.S. Tax Treaty. So we have the Internal Revenue Code of the U.S. We have Canada's Tax Law, Income Tax Act. Each country in Canada and the U.S. have 70-ish, 80-ish tax treaties. Yeah. What if, because you're still probably, we're talking about someone who hasn't changed residence in Canada, and now the IRS is saying, yeah, you're here more than half a year, you're a full year resident, you file a tax return with your worldwide income, we'll give you some foreign tax credits, so you shouldn't be double taxed. But you've got that inconvenience of filing with the...
Yeah, you still have to get someone to do the returns for you.
Yeah, exactly.
Right.
There is, under the treaty, you can basically default yourself to non-resident status, which still means filing, but a slightly less complex filing. So essentially, day 183 and on, got to file, can probably get out of paying tax, but you've got some complexities and you've got some costs and not fun stuff you've got to do. So that's kind of our line in the sand.
Okay.
Also accords with visitors' visas. My understanding is you basically get kind of 6 months every time you cross the border, and now we're going into immigration law. where
sure. Yeah, we won't trade into that. But I think what we've seen is that, if you're only there for 3-4 months a year, you're not going to run afoul of the problems. It's when you start getting to the 6-month mark that it's not a clean 6 months. There's a bit of a rolling average. There's a bit of math involved.
Yeah, right? That's important. So there's basically three. There's a couple limits. One is if you are over 183 days in the year, and it doesn't have to be consecutive. It's from Jan to December. You are now a resident.
Automatically.
And you're filing. You're either filing as a resident and figuring out your tax, or filing that treaty return you're filing. Now, but there's also what's called a substantial presence test. So the IRS has, quite rightly, has been at this a long time, figured out, hey, people are going to stay there for not 6 months or less a day. They're going to stay for 4 months, year after year after year after year. So they have the substantial presence test, which is a 3-year rolling test. All of this year's days, third of the prior years, 1/6 of the second year. Add that up. If that's over 183 days, you are again a resident.
Right.
And now that's easier to combat though, because you haven't hit that 183 in any one year. So you file what's called a closer connection form, an 8840, which is filed by itself.
Right, you're right. So there is a way out of it, but if you're not even aware of this is a surprise. So you do have to know that you might be at risk, and then you have to file that form, right?
Yes. Yeah. And the 8840 is basically an informational form. What are my days over the last 3 years? Who has my passport? What's my passport? What's the number? Where do you have residences? It might be both. Where do you have cars? It might be both. There's a whole bunch of questions. And the way I tell people is we want Canada to be the answer to as many of those 20 lines as possible. Right. You file it in and you hear nothing, but keep a copy, keep proof that you mailed it, because I said you hear nothing, but as long as you know you've got it with the IRS, should there be a question, say on that property sale time where you decide to start renting, the IRS goes, oh, okay, like you're a non-resident, are you? Yeah, here's my, you can check my 8840s.
But people have to know that.
Good thing to clarify. Thank you.
Yeah, and I think it's also important that if people are frequently traveling, there's apps and things that you can get where you can plug in, this is when I went, this is when and I think, again, if you're there frequently, it might be smart to have something that kind of tracks that that you know if you're rubbing up against the limit or not. And so that's when they should know, do I go get more advice and talk to someone like Carol to say, look, I've created this complexity. What do I do? And so, look, I'm going to wrap it up there. Thank you for your time today. We've covered a lot. So for anybody that's looking to buy a property, has a property and is enjoying it, or looking to sell it, I think we've established that getting really high quality, competent cross-border advice is absolutely essential. I always caution people, don't play the home game with this stuff. So thank you for proving my point.
You are very welcome. Glad to talk about it.
Thank you, Carol. Pleasure. And if anyone would like to reach out to Carol in Calgary or anywhere else, happy to connect you guys. And for all the viewers and listeners, thank you very much for listening to another episode. We'll be back to you again soon with more things that create complexity and tangliness between the two countries. So thank you.
Thanks.
This has been Two-Way Traffic with Darren Coleman. Thanks for watching and listening. If you have any questions or comments or ideas for new episodes, send us an email at twowaypodcast@gmail.com. And you can find the Two-Way Traffic Podcast on Facebook and Twitter. This series is a production of the Acme Podcasting Company.
On behalf of the Two-Way Traffic Podcast and Portage Wealth of Raymond James, thank you for listening to this conversation. This podcast has been prepared by and expressed the opinions of Darren Coleman and his guests, and are not necessarily the opinions of Raymond James Ltd. Statistics, data, and other information presented are from sources Raymond James believes to be reliable, but their accuracy cannot be guaranteed. This podcast is for information purposes only and is not construed as an offer or solicitation for the sale or purchase of securities. Investors considering any investment should consult with their investment advisor to ensure that it is suitable for the investor's circumstances and risk tolerance before making any investment decision. Past performance is no guarantee of future results. Information provided in this podcast is general in nature and should not be construed as providing legal, accounting, and/or tax advice. Should viewers have any specific questions or issues in these areas, please consult your legal, tax, and/or accounting advisor. Raymond James Ltd is a member of the Canadian Investor Protection Fund. Raymond James USA Ltd is a member of FINRA and SIPC. Raymond James Ltd and Raymond James USA Ltd financial advisors may only transact businesses in provinces and/or states where they're registered.